President Biden unveiling his budget proposal for the upcoming year. It includes a new minimum tax on billionaires and aims to put some restrictions on executives selling stock after buyback programs. Joining us right now is Brian Deese, he's National Economic Council Director. Brian, good morning to you. We've been having a raging debate on this set for the last, hour and a half and perhaps all of yesterday about the buyback program and the billionaires tax. I want to start with the buyback program and then get into the tax issue on the billionaire side. But can you make the case, if you could, so we just understand it, why a 3-year window, which is what I think the White House is pressing, makes sense, and whether it also creates its own unintended consequences for executives and their own incentives?
Sure. Well, thanks for having me on. Our current system over-encourages buybacks. It does so because they're tax-advantaged vis-a-vis dividends, and also because they create a pop in the share price that executives and others can take advantage of. So our proposal is designed to try to smooth out those problems and try to have more efficient allocation of capital. So first, equalize the tax treatment of dividends and buybacks. And secondly, say that if a company is going to engage in buybacks, then executives should have to hold on to the stock so that their interests are aligned with at least the putative rationale for the buyback program. We would do that by saying that on the back end of buybacks, the executives that have control over company decision making would have to hold on to stock for a period of time. As you say, we'd start with 3 years, but that's the kind of thing that we would negotiate out in terms of the details with Congress. But we think that that will produce a better allocation of capital and help to address what we've seen over the course of time, which is less productive investment, less R&D, and frankly, worse performance for shareholders. You know, we've seen recent research that actually shows that companies that engage in more frequent buybacks actually produce lower returns for shareholders across time. So we think that these are sensible proposals. We're not suggesting you should ban buybacks or restrict them outright, but that by equalizing the treatment to other forms of distributions, we'll get a better allocation of capital across the capital markets.
What do you say to investors, to business leaders who say, look, I'm trying to allocate capital as best I can. If I don't see a better opportunity in R&D or in hiring more people or necessarily making an acquisition, and for a lot of these big companies that are pursuing buybacks, making a big acquisition or even a small acquisition can be very difficult given the antitrust laws in this country, that my only option or my best option is to buy back my own shares.
Well, I'd say, first of all, there's no reason why you should have affirmative tax advantage to buy back shares rather than dividend or distribute it another way. Second, companies and innovators are constantly looking for productive uses of capital to grow and innovate, and we should be encouraging that in this country. What I hear from CEOs and from business leaders is that they're eager to try to find ways to put their capital to work, and there's no reason why the tax system or the structure of executive compensation should discourage them from doing so. So this is really about trying to get at the elements of our system that have led to this massive run-up in buybacks. Certainly distribution of capital is a sensible part of the capital markets.
In terms of the timeline, though, this 3-year period, is it too long? We were debating that earlier. I would make the argument, by the way, 3 years may be too long. Maybe it's a year, maybe it's 6 months, maybe it's a year and a half. Hard to see necessarily how it shifts the priority in terms of clearly you don't want executives selling into a buyback because that effectively is propping up the shares in real time. The question is sort of how much do you push that off?
Well, you don't want executives selling into a buyback, and you don't want buybacks being motivated by excessive short-term interests that don't align with the long-term profitability of the company or long-term productive investments. And so that's the core question. 3 years aligns with many typical vesting periods that have evolved in the private sector. And so certainly it's the kind of thing that we would be open to looking at and trying to get into the details on. But the goal here is to try to align the interests and the motivation of a buyback with the long-term interests of shareholders. And so the idea that a buyback is designed to try to increase the value of the company and be aligned with long-term interests is actually not radical at all, and it seems more common sense. 3 years, I think, is an appropriate starting place for the conversation, and we'll take it from there.